Introduction. Hello and welcome to this video on interest rates. In this video, we will be discussing the history of interest rates, interesting events that took place in the past in helping to shape the concept, and how people could benefit. We will also look at the good and the bad of interest rates. Interest rates have a long and fascinating history. The concept of interest rates dates back to ancient civilizations such as Greece and Rome, where moneylenders charged interest on loans. During the Middle Ages, usury laws were established to prevent excessive interest rates, and interest rates were controlled by the church. Interest rates began to take on a more significant role in the Renaissance era when banking and finance grew. The introduction of compound interest revolutionized the way people thought about lending and borrowing money. The modern era saw the emergence of central banks, and interest rates became a tool to influence economic growth and manage inflation. Central banks set interest rates, which had a ripple effect throughout the economy. One of the events that shaped interest rates, the Great Depression of the 1930s, had a significant impact on interest rates. During this period, the U.S. government implemented the New Deal, which aimed to stimulate economic growth by increasing public spending. Economist John Maynard Keynes developed a theory that suggested governments could stabilize the economy using monetary and fiscal policy. This led to the adoption of Keynesian economics, which advocated for the use of government intervention in the economy to manage and stabilize fluctuations in output, employment, and prices. This can be done through fiscal policies such as increased government spending, tax cuts, or a combination of both. In the 1980s, the United States experienced a period of high inflation. The Federal Reserve, the country's central bank, raised interest rates to combat inflation. This led to a recession, but ultimately helped to bring down inflation rates. The 2008 financial crisis led to a period of extremely low interest rates. Central banks around the world implemented low interest rate policies to stimulate the economy. This period of low rates has continued in many countries around the world and has led to concerns about asset bubbles and increased levels of debt. People can benefit from interest rates in a variety of ways. For savers, higher interest rates mean higher returns on savings accounts and other investments. For borrowers, low interest rates make it easier to obtain credit and reduce the cost of borrowing. This can be particularly beneficial for businesses, which can use borrowed funds to invest in new projects and expand their operations. Interest rates can have both positive and negative effects on the economy. Low interest rates can stimulate economic growth and encourage borrowing and investment. However, they can also lead to asset bubbles and inflation. High interest rates can help to combat inflation and prevent asset bubbles, but they can also slow down economic growth and make it more difficult for businesses and individuals to borrow money. High interest rates can also make it hard for individuals to keep up with payments on their loans. In conclusion, interest rates have a long and complex history. They have been used as a tool to manage the economy for centuries and continue to play a critical role in the modern economy. While interest rates can have both positive and negative effects, they are an essential part of the financial system and are likely to remain so for many years to come. Thank you for watching. And just like Thandi say, please subscribe and don't forget to hit the bell button. Bye.